Good morning, everyone, and thank you, ICAI, the Eastern India Regional Council, for giving me this opportunity. And I'm really privileged to address all of you today in Kolkata. And for a change, actually, I think after the fantastic speech by Dr. Sharnal, I think on the reviving the the Kolkata, I think it makes all of us nostalgic because all of us have been born here but moved out of the city in some course of time during the last 50 years. So, and it's a fact that this is the time when most of us come, most of the people who have been studying tend to visit Kolkata, and it's really very nostalgic because yesterday I was at one of the places in the new market, and the crowd actually showed me that the city is bubbling with life, but maybe as maybe some sort of an innovation or something could be useful in terms of ushering in a new Eastern India. Now, having said that, I think you have been hearing a lot about economy, and Mr. Sundaram will also speak about economy. But today I will try to add something differently. What I will try to do is that I will try to address as you know that in India there is a lot of regulatory institutions. The Reserve Bank of India is one of them. The SEBI is one of them. The Ministry of Finance is also one of them. And I think in the last, as our earlier speaker, Mr. Sarnal, was elaborating, I think the policy during the COVID times was more of an innovation. And if I just get a little bit into the textual, it was more of a discretionary based policy which actually had pulled us out of the COVID. Now, with this in mind, I will highlight some of these policy. Basically, I will make a distinction between a policy framework which allows rules and a policy framework which allows discretion. And then we'll give examples from India to say that how this has evolved over the last decade or even for the last 5 to 10 years from an policy approach which has been more discretionary based right now rather than rule based. And in fact, if it is more discretion based, it gives you more benefit to the economy. So this is basically the background of my address today, and I'll just try to give you some live examples of this which we have also encountered as a bank, and I also encountered in the course of our economic analysis. Let me start with some international examples. There was a recent report by the Bank of International Settlement. I think this Bank of International Settlements is basically, as all of you know, this BIS, this is the mother of all central banks in the world. It had an unusual warning saying that there is a significant amount of foreign exchange swaps. Basically, swap means you are getting into a transaction with another, which has been built up over the last several years, and that could be a blind spot which could put the policymakers in some sort of a fog. This was a word they had used. And the total amount of forex swap markets today, which the BIS estimated was around US 80 trillion. There has been an enormous participation from non-bank players like pension funds, equities, hedge funds, and who actually, and it's interesting, and I will get this issue in front of you, who have a very lightning touch relationship with the regulatory purview. And that basically the BIS highlighted that this could have a collateral impact if there was something to happen at some point of time in the future. The BIS actually flagged the off-balance sheet classification of this significantly high amount, questioning that how the prudence of these regulating entities could allow this practice to happen for a longer period of time. There has been also, against this background, there has been constant facets of innovation basically on policies which could be rule-based, as I have defined, which basically means that you are following a textbook policy, or discretion-based, that means you are following out of the textbook and trying to do something innovative for the markets. And as I will show it to you, this has happened in significant, recurring frequency during the COVID times by the government, as also as the Reserve Bank of India, and to also some extent by some of the other regulatory agencies like SEBI. So The important point to note is that today the economic activity, the policy making is grappling with an apprehensions about a very hazy future. As all of you know that today the only certain thing today in this world is the word uncertainty. And a continuous reconsideration of basic principle is needed for designing an effective and flexible regulatory mechanism which can deal with financial innovations and evolving systemic risk. Because please note that markets are always very advanced and markets try to run ahead of the regulators. In this context, the natural question is how much importance should be given to discretion-based policies, which means that you are not following and particularly textbook-oriented wisdom, and how much to the rules. And this is exactly what I will speak about today. Now, let me define rules versus discretion policies in the Indian context. Policy making frameworks, as I have said, are either rule-based or discretion-based. In a rule-based framework, policy responses always follows a pre-specified plan. That means, for example, if I take the example of the COVID crisis, all of us had a preconceived notion that this was a crisis which was engineered by demand issues, so let's concentrate on that demand. The rule may force policymakers to pursue the same course of action in all circumstances, as all the developed economies have done, or it may direct policymakers to respond to different circumstances in different predetermined ways. And India, I think, perhaps was an only different in this case. The common denominator is that rules are supposed to constrain policymakers' action in advance. Now, having said that, in a discretionary framework, policymakers have wide latitude to design the best policy response for any given circumstance. Proponents of discretionary policy note that flexibility allows policymakers to respond to unforeseen circumstances, scenarios, and innovate continuously. So that's why I have used the word innovation in the financial markets in terms of discretionary-based policies. Now, having said this, let me now give into some specific examples about monetary policy, fiscal policy, and other also government policies, which we face every day. Till the 1990s, since I come from a bank, so I'll just talk a little bit about the monetary policy, is that till the 1990s, as all of you know, there was a famous Robert Lucas. He's actually has been won the Nobel Prize. His argument was that monetary policy always affects real variables. So all the policy changes, only if the policy changes are unanticipated. So therefore, this ensured obscurity over openness and clarity. And there was no message, and all through the 90s, there was this wisdom that whatever the monetary policy makers or the central bankers will do, that has to be hidden in obscureness and non-clarity. However, in the 1990s, two famous economists and who again got Nobel Prize, they were Kydland and Prescott. One of them unfortunately passed away very recently. They were the first time to argue that in favor of a rule-based policy, but their argument was that rule-based policies should be transparent, efficient and credible, and that was the beginning of the debate of rules over discretion and more central bank transparency, and also the difference between a rule-based policy and a discretion-based policy. Now, whether it is difficult to vouch whether a rule-based policy or a discretion-based policy for policy making, there are empirical research. Here again, one noted economist, who has been a proponent of macroeconomics, Gregory Mankiw, has showed that a discretion-based approach, if it is followed, it always has a desired purpose if the regulator has credibility. So again, I am just getting into this debate of rule versus discretion through examples. And in recent years, as all of you know, that many central banks have adopted inflation targeting to control the general rise in price level. The Reserve Bank of India in 2016 had moved to an inflation targeting regime. In theory, inflation targeting is very straightforward. However, for example, the central bank has to forecast the future path of inflation, compare with the target inflation rate, and the difference between the forecast and the target determines that whether the central bank needs to act or not. As all of you know, recently the Reserve Bank has been hiking rates because the inflation was outside the tolerant range of 2 to 6%. I think it was more than 6%. Most countries, however, there is an element over here. The inflation targeting, what India is doing today, is actually and combines an elements of both rules and a discretion. Why I say this? Because it's a discussion framework. Why? Because it combines two distinct elements. First is that a precise numerical target for inflation in the medium term and a response to economic shocks in the short term. If you notice, the term is flexible inflation targeting. That means you are targeting inflation over a business cycle and not at any point of the cycle. And that actually has given the central bank the advantage. And there has been a lot of debate also, as all of you know, in the public domain, that the inflation in India has been consistently stayed over 6%. I am not getting into the reasons why it has gone. It has now declined and is projected to decline significantly in the next couple of months. But the idea in the inflation targeting framework also, it's a rule versus discussion. The rule is that you are targeting the inflation rate. The discussion is that you have to be flexible and nimble enough so as to target it over a point of cycle and not get distracted by a couple of points. And this is exactly what the Reserve Bank of India has been trying to do. Rather than focusing on always achieving the target is basically the 4% midpoint. The Reserve Bank has emphasized the target over the medium term, typically over a 2 to 3 year horizon. This allows policy to address other objectives, for example, smoothing out the economy over a short period of time, because the economy needed support in COVID and the Reserve Bank provided the support in terms of liquidity in conjunction with the government. But when it was required that the inflation has to be controlled, Reserve Bank also started raising rates. So within the same inflation targeting framework, the regulator was both nimble and approached the problem with a rule and a discussion based. And whatever the policy choice over here, another important thing which I'll tell over here in terms of the monetary policy is the word communication. Because in any policy, and what is important is that if you are using a discretionary based policy, you need to also convince the markets, because you have to convince them that this policy, what we are doing, is actually good for the economy. So I'll just spend a few words about the policy role of communication in monetary policy, and then I'll also talk about the fiscal policy and other policies of the government of India where there is a clear distinction between rule and discretion. Realize the importance of clear communication and greater transparency in enhancing policy effectiveness. Central banks over the last several decades have consciously made changes to their communication policy. The Reserve Bank of India has also done the same thing. It is commonly called, if you have gone through any of the policy statement, is called the forward guidance. Forward guidance means you are trying to guide the market that what you may do in the near future. For examples, during the recent years, upheavals and chaos, the distance of the Fed from providing explicit forward guidance can be best summarized as, I'm quoting a statement from a Fed governor, Michael White, in October 12, 2022, where he said that in uncertain times, it is always difficult to not to provide for forward guidance, because the world is uncertain today. You can't say that what is going to happen tomorrow. We had a significant geopolitical conflict which has been happening from February. We had a situation now in China where every day we are hearing in papers that there are so many people getting infected. The markets have been impacted in the last 3 to 4 days in terms of a significant meltdown. So in such a situation, what is important is to guide the market not in terms of a forward guidance, because no one knows what is there in the future in terms of an uncertain global economy. So his words were, just give me 2 minutes, to be considered forward guidance, a statement does not need to be explicit about future policy actions or the timing of potential actions. It may be more qualitative in describing likely policy actions that may be taken in the future. And in some cases may only describe it is called the FOMC, just like the MPC committee in US, it's called the FOMC. The FOMC will be thinking about the future decision rather than signaling the likely future direction of policy actions. The intent of all forward guidance is to influence the public expectations about the FOMC's future policy actions, and in doing so, affect the interest rates and financial condition, which will support a path for inflation and economic activity that will be consistent with the committee's price stability and maximum employment goals. So you can understand over here is that the central bank keeping the options open of what it's going to do tomorrow, even because of an uncertain world. Overall, if I conclude for the RBI central bank monetary policy, in the monetary policy space, we have seen an adoption of rule-based regimen, and this has happened across several countries until the 1990s, which, however, from the 90s has given way to discretionary-based monetary policy making. An example of a discretionary-based monetary policy making, you all know about this liquidity support which Ben Bernanke had introduced in 2008. And in many areas, this debate about rules and discretion is pertinent, including the fiscal and the regulatory space. So now let me move into some of the fiscal examples in the Indian context where this had actually happened. India, as all of you know, in the 1990s, India used to run an 80s also very high fiscal deficit. The average was actually close to 6% of GDP. The higher fiscal deficit implied that the economy impacted the economy through higher inflation. The market borrowings were higher. So if there was higher market borrowings, the private investment actually was crowded out. That means the private investment could not borrow enough from the market. However, in 2003, and this was one of the reforms which the NDA-1 government had done in 2003, was bringing about the FRBM bill, which is called the Fiscal Responsibility and Budget Management Act. A conscious effort was made to rein in the fiscal deficit of the center and states. FRBM Act was aimed to institutionalize financial discipline, reduce India's fiscal deficit, improve India's macroeconomic management, and the overall management of the public funds by moving towards a balanced budget and fiscal prudence. And according to the FRBM Act, the deficit was to reduce by 3% in 2007-8. This actually led to a rule-based regimen in policy making. So sometimes some rules are good in the Indian context, because in India the fiscal policy was, over the 80s, 70s was largely discretion. We used to have high deficits, there was no accountability. So this was perhaps a good thing when we moved to a rule-based regimen in policy making. India was moving towards a low fiscal deficit. In 2007-8, I remember our fiscal deficit was 2.5% of GDP, because there was a significant revenue buoyancy given by the global growth and Indian growth. However, the international financial crisis and even the recent pandemic has prompted the government to deviate from the fiscal consolidation path, and now the government actually targets at this 4.5% of fiscal deficit by FY26. So basically, see the transition over here. Earlier, it was a completely discretionary policy. In 1780s, high fiscal deficit, rampant inflation, running a public debt. Then you moved to a rule-based regimen in fiscal policy to the enacted of FRBM Act. But again, we have moved into a discretionary policy, which is, however, better for Indian context, given the fact that pandemic disruption was significant, and it was imperative that we push the path of fiscal consolidation a little towards the future. In 2017, I think the FRBM committee had submitted the report, and the government had accepted the report in 2018 to bring down the central government deficit to 40%. Government also accepted the recommendation. The objective, as I said, was to move towards 3% of GDP. That is now at 4.5%. However, the example over here, which I want to put over here, is that India quickly during the pandemic, India realized that it is very difficult to move through a path of fiscal consolidation when there was actually the economy was closed down. And so therefore, the target was reset. The target was reset to 4.5%. And let me give you an example today. India was perhaps the only country, it was perhaps the only country during the pandemic which showed an improvement in the tax buoyancy. India's tax to GDP ratio has gone up in the last 2 years during the pandemic, where every other country has seen a fall. So perhaps the message was clear. The policy has to be tailored to the context of the country. And there are examples also over here. I think I'll not get into that. There is a definition by the International Monetary Fund of a fiscal deficit, which should be different for different country. But let me leave aside that. Now, let's see some of the examples of monetary policy, some of the rules and monetary policy. As all of you know, Sanjeev was talking about bank cleanup. The work with the RBI, both painful cleanup. Today, what the financial system actually very sound in terms of the credit growth sound banking system. You know that in 2007 it introduced an action, but its prompt corrective action example which was taken, but for the it was rule based. US framework, it is called action framework, where put in the prompt, I think right now taken out, where you will be not allowed to lend till your improves. But this framework is employed as a form of structure early intervention and resolution mechanism. It is designed to help banks by in India. Reserve Bank of India 2002, which was introduced, it was more of a policy. Let me give you some examples. The reason provisioning, all of you know that the banks, if some asset goes bust, the banks have to make a provisioning. Provisioning norms in comparison between provisioning norms and the US norms, in subjected to age-wise provision for standard assets, 15 year, 20 second year, 40, 100% in 4 years if the asset remains in the NPA category, irrespective of whether it is available or not. US provisioning is, however, completely discretionary, provided by the bank on their estimated. For a mortgage loan, for example, if it is equivalent for 200 and only if the real the collateral servicing the loan, that mortgage is possible on accrual status. Mortgage loan is fully insured, even placed on accrual status even after 90 days. This is while the FDIC, which is called the developer in US, triggers the based on bank capital threshold. The RBI PCA threshold asset quality. Anyone can understand in a situation when a bank is PCA norms, profit may not be a particular criteria in terms of the PCA framework. To summarize, the provisions in India are rule based. Example, but here actually the example is the RBI has worked is the adoption of norms in India. In case of the Basel III norms in India, the standard prescription 8%, the result had made it at 9% on an ongoing basis. Again, during the pandemic, trigger which is called the capital conservation buffer, which means the economy slows down. When the economy slows down, that can be discretion in we may have to move up a little. In US, example, during COVID-19 location data, experts said that though they travel to less than a mile a day, average from a might sharp of the coronavirus. Also observed that public officials that were delayed stay, people change their habits far less. Though in those places, basically, they were more than 3 times those in areas that had imposed lockdown orders. Yeah, I think on that path, but evidence-based policy, I mean, we have been doing initiatives on the financial inclusion space, get into that. I think has an stands a significant as we move along in terms of an evidence-based policy. For example, for vast swath of us who have traveled back from across states as well as within states could have good for skilling and even validating with the existing databases like PMJD, Prime Minister, Ayushman Yojana, Bharat, etc. All of this has an enormous amount of, all of this database could be evidence-based policy discretionary in nature. This will give the government a clear intended beneficiary, building up a credit history of such borrowers at the bottom. This is very important because we have been the most of the government policies which has been targeted at the, and it is imperative that we get up a call records for all of them so as to get them into the banking. Interesting, a range of are cited by regulators, particularly in India, which prevents the use of telecommunication data to shape policy and related decisions. I find it very surprising that there is always a debate that data privacy and other issues, because in Google today, everything, all information about us are actually in the public. Let me bring an example over here of the UK government. The UK government has a telecommunication and related data for public purposes. But if you want to do it in India, there could be an hue and cry. The aforementioned power has undergone a metamorphosis from Data Retention Act 2014 to Investigatory Power 2016 to Data Retention and Acquisition Regulation 2018, and reference has now been drawn to an Coronavirus Act 2020, where it clearly says that the government has all the powers to have access to telecommunication data for evidence-based policy making. Similarly, in India, there could exist a case for government to access telecommunication related data for prudent policy decisions. This has to be, however, balanced with the concerns of privacy. But here again, I give an example. Fundamental rights such as the right to privacy under the constitutions are not absolute and subject to restrictions imposed under Article 19.2 provides the measures meet the doctrine of proportionality. I just wanted to give you an example that we have huge swaths of data, and this data could be effectively used through evidence-based policy making, and that has been done in other countries also. And while we have having so many policies at the bottom end of the pyramid, I think India could be the best place to use this data. Another example I am giving is that the Monetary Authority of Singapore has a detailed framework for developing public cloud services, because where data could be stored. And this has actually gained prominence during COVID-19. In India, we have an unprecedented pace of digital transformation. The total compounded annual growth rate of the UPI transaction in the last 5 years has been 350%. And these numbers, if you look at the UPI transactions, if you look at the UPI volumes, and this has actually been phenomenal. Given this unprecedented pace of digital transformation, the RBI actually could develop a suitable template using more of discussion-based storing of data on a cloud. And this could actually allow the banks and financial institutions to harness such data for evidence-based policy making. Again, an example of how discussion in policy could help us in our better state. Let me, before I conclude, I'll just give an example of the capital markets, and then I will just conclude. I think recently, as all of you know, in India, we have several rating agencies. In 2019, SEBI actually had come up with a landmark judgment where it said that all these rating agencies, when they rate an entity, one of them rated at AAA, other one could rate at AA, another one could rate at A. So it clearly said that there has to be a rating convergence across these entities, because it cannot be the case that if an entity A is rated AAA, the other entity is saying it AA. We had as all of you know, we had the IL&FS crisis in 2018 when this was thoroughly exposed in terms of the rating of the instruments. And this actually, today it is yielding results. If you look into the rating agencies' rating of all the papers, a certain amount of convergence across rating institutions has been achieved. And recently the SEBI has also made a policy announcements of banning and regulated entity from the market because it has not to meet to norms. There are several other things I'll not get into, but the important point to note about SEBI is that there are some areas where there could be some more discussion-based policies. For example, the enforcement mechanism of SEBI may not have the desired impact because the consent-based settlement process has sometimes been to discipline some of the manipulators in the market has not gone proper address. The another example of SEBI's proactive, maybe more proactive enforcement could be probity and fairness of regulation of key market institutions like NSE. We had a lot of stories about NSE, which I don't want to get into. But the good thing is that all institutions like the SEBI, the Reserve Bank of India, and the government of India has also been allowing policy to be more and more discussion based. Let me end with a conclusion, and this is very interesting. I think I'll just, and because this will be the future of the financial innovation in the markets. In 2021, Jamie Dimon, who is basically the head of JP Morgan, had given an address to the shareholders whereby he has clearly said that there are disruptive green shoots changing the banking landscape, and how the choices before the regulators are increasingly getting complex, limited and foggy in find the best recourses that stand the test of time to come. Let me just quote very quickly. Banks around the world are already engaged with tough competition with each other. A quick review shows the huge size of the non-banks, payment companies, fintechs, big tech, and these are all getting innovation into the system. They are competing with traditional banks, but these do not include many others who are within the regulation. For example, Fidelity, Vanguard, all provide banking type services. The pace and change and the size of such competition extraordinary. For example, Walmart, for good reasons, 200 million customers visit their stores every week, can use new digital technologies to efficiently bring banking type services to customers. Apple Pay, Apple Card is actively extending services into the other banking type products. The large tech companies are already 100% digital, have hundreds of millions of customers, enormous resources in data and proprietary systems, all of which gives them a competitive advantage which is extraordinary in nature. So basically the world is getting competitive, and we all need to, the regulator has to think out of the box, and again the importance of this discretionary based policy making. Properly regulated banks are meant to protect and enhance the financial system. They are transparent with regulators, and they strive mightily to protect the system from terror financing and tax evasion, and they implement KYC and anti-money laundering laws. They also protect client assets and money in movement. They also help customers from protecting their data, minimizing fraud and cyber risk, in providing financial education, and must abide by social requirements such as the Community Reinvestment Act. So in essence, the regulators need to figure out how they are going to compete, how they are going to make policies in this world which should be more geared towards discussion and not towards rules. And I gave the examples of these forex swap. I have not given the examples of the LIBOR scandal which broke out in 2012, and that was also a result of policies which were mostly strictly textbook based. So in conclusion, rule-based regulation which emphasizes getting the regulator to obey the letter of the regulation typically involves more direct control by the regulatory authority and has been the preferred mode in emerging markets. We need a reconsideration of basic principles for designing an effective and flexible regulatory mechanism that is capable of dealing with financial innovations and systemic risk. I think India is on the cusp of a structural revolution today. We are now the fifth largest economy, and all indications show that we could be the third largest economy by the end of this decade. In terms of purchasing power parity, as Sanjeev said, we are the third largest. So I think the stage is ripe. The stage is ripe. India is innovating. Let the regulators also innovate so that it could take markets and all of us forward for a better India tomorrow. Thank you.